Okay. And again, ladies and gentlemen, it's great to be with you here. And we're going to be discussing how I go about doing some short-term trading. I have an instant poll for you. Are you a scalper or a short-term day trader? Have you ever tried it before? And we have 4 answer choices for you. Yes, all the time. 2, sometimes. 3, never. It's too risky. Or 4, thinking about it but need help to get better. Let's go ahead and fill out that poll. And as you do, we'll wait for some more people to come in the room. We'll get started in about 4 minutes. But I've been trading for about 20 years. I'll tell you a little bit about myself. I've been trading for 20 years, 8 years, and was spent with the world's largest forex broker in the world. And I developed short-term trading for myself because I would get into these positions, these swing trades, and I would be up 15 or 20 pips at a time, and then all of a sudden, I would, the price action would turn against me, and I would just stop it out at a loss. And then I'll do the same trade again because maybe the same fundamentals were still there, and the reasons for entering the trade were still there. And then I wanted to do so, and then what happened would, I would get stopped out again, be up 15 or 10 pips, and then it would turn around and get stopped out again. And then I would do that again. And I'm going, you know what? What if I just took those 15 pips or those 10 pips and repeated that? If I'm going for 50 or 60 pips on a swing trade or 100 pips on a swing trade, I could take several trades in a row. And and that's how it was started. People say, well, you're cutting your profit short. Well, if it's only going to go up 15 and drop out, then why don't I just take the bird off the screen? And we'll see, a bird in hand's worth 2 in the bush. I would take the 10 or take the 15 and wait for it to come back and do that again. And I see Steve. Yes, Steve says you need to know more info. Yeah, definitely. I'm going to give you some good solid methodology where you can start exploring it. And again, the short-term day trading is one of the most cognitively demanding forms of trading, and it's it's like driving the autobahn. If you haven't learned how to drive first, driving at 85 miles an hour on the autobahn might be a little a little too advanced. But we're going to show you some of the things that you can build up start building yourself up for short-term trading. In fact, I coined the term Pip and Run because it sounded like hit and run, like, in fact, a gentleman by the name of Jeff Cooper had a series many years ago called Hit and Run Trading. Well, that sounds kind of violent. And then Forex use pips. So let's go about Pip and Run. My tie matches the logo. I know, isn't that pretty neat? I think I was at my daughter's high school graduation. I couldn't find a picture of my suit. Since I professionally trade now, I try not to wear a suit, but they wanted a picture with me in a suit and tie, and I had to search my database looking for a picture of me in a suit, and my daughter's standing next to me, and she's graduating. That's why I have that, and I had that tie. That's a little story behind that picture. All right. And usually I wear like a polo shirt or a Hawaiian shirt. That's I don't work for a stuffy brokerage organization anymore. But thank you so much for your compliment. Okay, we're about to get started in about a minute or so, and we're going to do look at some Pip and Run. And I'm gonna actually I had to format my computer. So to get Windows 8 off of it and put Windows 7 back on it, so I might see if we have our program here. All right, so we're going to go ahead and get started. And again, my name is Greg McLeod, and welcome to Pip and Run Scalping. And it's brought to you by Aura FX, seeing beyond to maximize your profit potential. And this is a wonderful webinar which is going to show you some of the tenets I use for doing short-term day trading. Now, there's an instant poll in front of you in which it asks 4 questions. Yes, are you a scalper or a short-term day trader? Yes, all the time. 2, sometimes. 3 is never is too risky. 4, thinking about need help. And we can see that we've have it's kind of evenly split. Um, those who felt it was too risky, well, you wouldn't be here anyway, right? So that question, I'm glad to see that there's no answer there. And thinking about it and need help, we've come to the right place. And those of you who are doing it sometimes, hopefully you'll get some strategies to actually help you out as well. And yes, all the time, those 2 people, hey, there you go. We're brothers of another mother, sisters of another mother as well. Okay, so I'm going to go ahead and close the poll and close it like that, and then we'll go ahead and get started. And let me give you the risk disclosure on your screen. Make sure you understand all the risks associated with foreign exchange trading, and you should be aware that that this is not any recommendation to buy or sell any type of securities. Okay, and a little bit about myself for those of you that didn't hear or just entering the room now. I'm a professional trader in 20 years trading in the markets. My first trade was soybeans, and I tripled my money. I put $1,000 in a futures account, and I bought Novi beans, and it went up, and I tripled my money. It was my first winning trade. Sometimes they say the first winning trade is a kiss of death because now you think you're invincible, and you think this stuff is easy, and then it turns into a long, arduous journey. And hopefully, with my experience, I can help you shorten your learning curve so you won't have to wait decades in order to learn how to trade properly. And I have the unique opportunity of the unique experience of working behind one of the world's largest brokers in the world, and being able to learn how it operates from the other side of the curtain. I feel like I'm like Dorothy going to the Emerald Palace and going back to follow the yellow brick road into the inside, being on the inside, and then coming back and learning lots of things I can share with you. And so we'll go ahead and take a look at those things. So let's. And now I work. Now one of my specialties is high frequency trading, and so a lot of time I might do 50, 60, 70, 100 trades a day. Which probably people, well, how can you do that? Well, once you find the trend, you can start hitting the bid, hitting the ask on that, and really getting things going. A lot of people will look at my statement and look, oh, that's like a machine that did it. It's like, yeah, I'm like Neo, I'm like a machine, right? But I work with RFX live account clients, and normally people pay me $250, $500 an hour to work with me, but I work with RFX and I work with clients there as well. So, all right, let's get going with the preliminaries here. And maybe a quote from one of my favorite writers, military genius, was Sun Tzu. Sun Tzu, The Art of War. Many people have read this book, and Gordon Gekko quoted him, and that's probably why I started reading it, because Gordon Gekko it's recommended that you should read it. As log or stone rolls down a hill, good soldiers seek effectiveness from momentum, and that's what we do. We want to find where that momentum is and ride it, and ride it we shall. And we'll see how it works. And this is my logo, Pip and Run. I explained the relationship hit and run, high speed, why buy and hold weekend Pip and Run is my motto. And you can find me on the web and things like that. So a guy grab a bag of money, and I go, that's me. And so I'm going to talk about the 6 trading pillars for scalping. Six pillars. And so when you walk away from my presentation, you're going to know time, terrain, tactic, tool, trend, and trigger. These are our 6 T's that we use that I use in my trading, which I found very helpful to remember these things when I'm going to undergo any type of scalping trade. Okay, so let's get into it, in the meat of it. Okay, time. That's the first one. Timing is everything. And so we want to be able to know when, even though the Forex market is open 24 hours a day, there's some times of the day that are more advantageous to others, and sometimes these times there are times that don't provide any trading opportunity whatsoever. Now, you can trade during that Asia session from 7 p.m. to 2 a.m. Eastern time. I prefer maybe like 9:30 after the lunch in Asia. That's about 9:30 Eastern time. They get that lunch. Now the Nikkei will take a break and they'll actually close the market down for lunch, which is nice. And then after that, it'll start going a little bit more. You'll get some overlap between the Tokyo session and the London session, which is going to give you a lot more trading opportunities. So when you have overlapping of two sessions, that's where you're going to find the most volatility. I also like trading before the U.S. session, 4 a.m. to 7 a.m. Eastern time. And that's EDT, so more like 3 a.m. Eastern Standard Time. That's 1 hour. So 3 a.m. and that's for UK time. That's like 9 o'clock, about 8, 9 o'clock UK time. I want to be looking at the market, even looking about 30 minutes before the market opens to look for, because what the market makers will do they will establish a high and low range, and then they'll establish a breakout zone. And when prices break out of that zone, either north or south, prices will continue to move several, maybe 20, 30, 40 pips in just the first hour of the London session. So being able to get in there early, mark out the high and low of that period, and then looking for that breakout is very important. Okay, and I like being out by 7 a.m. because 7 a.m. Eastern time, and you add 5 hours to it, that's going to be London lunch. Okay, and hey, when they're going for the sarnie and chips, and they're going out, the city workers, they call London, the traders in London, they call them city workers. When they go to lunch, the market dies. It gets kind of flat. There's nothing really going on. So I want to be out by the time they go to lunch. And so in the U.S., it's going to be really early. If you're trading like California time or something, it's going to be like 2 a.m. Eastern time. In fact, I used to trade in California and Los Angeles area, and I would have to get up at maybe 1 o'clock in the morning. But I was up anyway watching a late night movie or something like that. So, it's just a matter of staying up and turning on your computer and getting going with that. The European close and U.S. lunch, I call it the Happy Meal reversal time, about 10 a.m. to 12 p.m. That's when Europeans are going to lunch. They have to close out their positions. So if they have been long for a long period of time or short for a long period of time, and they have to get their profits before they go home. If they're long, they're going to have to sell their positions to collect money. And if they're already short and they've made money, they have to buy their positions back to close their positions to make money. So I look for currency pairs which have either rallied all morning or have dropped all morning, and I look to play that Happy Meal reversal, where these traders are either between Europeans going home and U.S. traders going to lunch. They go to lunch and go home about the same time. You're going to find this changing of the guard, or this reversal period. And I call that the Happy Meal reversal. But usually I'm out, if I can't find anything between 4 a.m. and 7 a.m., I'm usually, going out, going to the mall, going shopping, having some coffee or something like that, but or going to a movie or something in the afternoon or something. But I don't usually get into this time period here. But if you're looking for another time period, this reversal, the Happy Meal reversal, and they got on me for saying Happy Meal reversal because of the golden arches, so I had to call it the lunchtime liquidation. Okay, so I also avoid domestic and foreign banking holidays, particularly UK holidays. If the UK is on holiday, I'm on holiday. Okay, because UK accounts for about a huge amount of Forex volume. About 85% of Forex volume comes through London. London is the capital of Forex, so if they're on holiday, I really don't like looking at the market. Or if there's a U.S. holiday, if there's a U.S. holiday, the liquidity gets thin, and you want liquidity and you want volume so you can get into a market. You want to be able to get your order in and out, and if there's no one to take the other side of your trade to get you out of the trade, you may be subject to a lot of slippage. So that's just my personal. Some people like it because they get big wild moves and stuff like that, but I like when there's a lot of people. I don't like playing. If you're trying playing soccer in a hurricane, you're the only one out there. Everyone else is like hidden and locked up somewhere, and you're out there by yourself and there's a hurricane coming or a monster or a typhoon. You just don't want to be out there in that type of turbulence or volatility. I also avoid month end, quarter end, year end, because a lot of fund managers they get paid quarterly or they get paid at the end of the year. They get a bonus, and they're not probably going to endanger their month end bonus by trading. So you're going to find like the last week of February, wow, a very choppy market. And a lot of the traders are working with me. They're like, "Hey, Greg, boy, I got really tore up last week. Like, is it month end? Yeah. Well, okay, that's probably what happens, right? And I don't like Mondays. A lot of traders take 4-day holidays. They'll take off on Friday afternoon. They don't come back till Tuesday. So you'll find the market will go one direction on Monday and flip directions to get turnaround Tuesday. That's where you get the term turnaround Tuesday from, because the liquidity is kind of thin. Market's going one direction, and then on Monday, manic Monday, and on Tuesday everything turns around. So I just take Monday off. Occasionally I'll play some trades on Monday. Okay, connection kept dropping out. Okay, well, you know what? We have a recording, and hope the recording is solid, that you'll be able to review it and come back to it. I'm sorry, Joni, about that. Okay, the next trading the pillar is terrain, and here is a quote from Sun Tzu. You need to be aware of the terrain and its effect on your soldiers as well as the enemy. This will allow you to fight with advantage. Terrain is what's around you, the landscape. If you're in battle, if you're going to war, you're looking for hills, you're looking for mountains, is there a stream? You're looking at around, there's like a forest, you're looking at the around you. Now, when you're trading, you're not looking for forests and mountains and trees. These are all figurative things I'm talking about. What you're looking for, or the mood of the market. You're going to determine the mood of the markets overseas, because if you're trading in Europe, it's very helpful to know what happened in Japan. If Japan had a typhoon or an earthquake, that's going to create panic and shock, and maybe the FTSE and the different indices are trading down because of that. Okay, so you want to check the news. You want to check the Dow futures to see how the U.S. equity market may open up. You can you can go to Bloomberg and see how those Dow futures, they can predict if the U.S. stock market is going to be positive or the U.S. stock market is going to be negative. A lot of money circulates back and forth between these markets, money moving from Asia, because if the Asian market is scared, they're probably not going to move their money into the European market, and it's not going to move into the U.S. market. So you want to take the pulse of these other indices, even though people say, "Hey, Greg, I just trade Forex. I don't care what goes on with the Dow or the S&P. That's why I trade Forex." Well, you can't trade Forex in a vacuum. There are other things around you they have to be aware of, or you might be blindsided. You may say, "I'm buying its support on the Aussie dollar," right? And all of a sudden, why does support just give out? Because the dollar is safe haven and people are just running into the dollar, and so your long Aussie just got messed up, right? But you didn't know that because you're not up. And now I'm going to show you about the terrain. So positive overseas markets can carry into the next market open. Markets seem to oscillate from a risk appetite or risk averse. Okay, risk appetite means that traders want to take on risk. They want high yield currencies. They want to trade stocks. They want to move out of bonds. Now, if there's maybe a war going on, or an earthquake, or tsunami, or a global financial crisis, people will be risk averse. They'll move their money into the U.S. dollar, where they can put it into treasury bonds, the most liquid, deep market that, for safety. So they can buy treasury bonds that yield like 2%, right? They'll run to the Japanese yen. They'll run to the Swiss franc. Those are safety plays. They'll run into gold. They'll run into things which are safe. And if they are moving into that direction, that's when we may want to short euro. We want to short pound versus U.S. dollar. We may want to go long dollar CAD because money is moving into the U.S. dollar. So having an idea of the mood may give us a clue of what currencies to trade, whether it's risk on or risk off. Okay. So you need to be aware of the terrain and its effects on your soldiers and on the enemy. So Bloomberg is good for taking the pulse of the market. Go to Bloomberg.com and their size is a little bit more confusing now, but still you can find that data under the market map. You can scan Forex factory headlines for Forex specific news that may be in the forefront of trader minds. Like, for instance, we had the Bank of England rate announcement, we had the ECB rate announcement, and so the currency pairs that are in play were the euro and the pound. Whether you're trading pound Kiwi, the pound versus the Aussie, which is it just skyrocketed. The euro was very kind. We took, and people in my group took, we were getting pips all over the place on the euro as we moved out of a breakout condition. I'll show you on my webinar, Trading the News. I got screenshots of that, and you can see how that did. And then we have non-farm payroll tomorrow as well. So we're going to find that the euro is going to be in play again because it's considered the anti-dollar. And so people will be trading the euro. So those strong correlations between currency pairs and the equity markets can help keep us on the right side of the action. There's a high correlation between the yen pairs and the S&P 500. And so we could play that correlation that as the S&P has gone up to 2100, we'll look at the Japanese yen, the dollar yen pair has gone up to 120. Okay. So tactic is what we actually do, what we implement. And so the things we do after we've determined the time we're going to trade, we determine the terrain around us, what we're going to look for in trading. We want to buy near support, daily or weekly S1, S2 classic pivots, and the pivot points are commercial support and resistance. They're based on a simple formula. They take the high, low, and close, divide by 3 to get the central pivot point. And then they derive S1 and R1. R1 is resistance. R2 is a little bit higher resistance. And then there's S1 support and S2. And these are extreme points. And usually what happens, price will move to one of these points, and the computers, the algos will trigger, and then they'll either start buying or start selling automatically at these points. And you'll see these acting like magnets in price. It's remarkable how these, and pivots have been around a long time, long before handheld computers. These guys in the pit would have a card, and that card would have 3 numbers on there. You know, they'll have maybe an R pivot, a central pivot, and that's one pivot, or the high, low, and close of the particular previous day. And if price comes near that low, they're buying. If price is near the old high, they're selling. All they know is the 3 numbers. That's all they know. They didn't have charts, they didn't have Palm Pilots and all that, all this little wonderful technology. You go, Greg, what's a Palm Pilot, guy? Or your handheld tablet. Okay, I'm gonna change the presentation a little bit. Dating myself. Okay, so looking at these pivots, and you confirm with indicator divergence, where we can use different types of indicators to show us the way. Risk management is a pillar, and we want to limit when we're scalping, keeping your stops between 9 and 15 pips based on market volatility allows you to recover in case if you make a couple losses in a row. Now, short-term day trading is one of the most cognitively demanding forms of trading, and you gotta be at least, well, trend trading is a little bit more forgiving, but you can be 32% correct and 68% wrong because you have a 2-to-1 risk-reward ratio. Frequently in short-term trading, your risk-reward is going to be upside down. You're going to be like risking 2 to make 1, okay? Or maybe you'll go 1 to 1 or 1.5 to 1, okay? So typically your scalping targets are going to be a little bit smaller because you're just not going to have the luxury of having a 2 to 1. So when you have an inverse risk-reward, you're going to have a higher accuracy. You're not going to be able to be wrong 68% of the time and be able to come out ahead. You're going to be right about 75 to 80%, 85% correct, and that can be very difficult for many traders to do. And so, so you want to keep your stops small so you can recover and then you can get in the right direction. Okay. So I usually break up my position into 5 parts and scale in as price moves against me, maybe for every 2 to 5 pips. Because if my overall indication is for a long trade, and I put my first part of my position on, I just leg in, maybe take a 1/5 position, and then a second fifth, and a third fifth. And once I have my full 5 parts in, then I put my stop in and let's see how far we can get. Usually the position I want it to limit out within 5 minutes or less. If it does, I can re-enter the trade. And sometimes once I get into the cycle, I might hit that same trade several times in a row. Okay. So tool. 6 trading pillars. The next the pillar we're going to look at is tool, that's what I'm using. Okay, and I like pairs with tight spreads and robust pools of liquidity. Okay, I have some guys. They want to trade pound kiwi. They want to trade, euro kiwi. And if you don't have enough volume and volatility, a lot of these short-term patterns are not going to hold up. They're going to break down. And so I want to have where there's a lot of volume, where I can put my trade in and get out, and there's someone going to take the other side of my trade. Euro is going to have a lot of liquidity. Dollar yen is going to have a lot of liquidity. Euro yen, a lot of liquidity. And if I want higher volatility and with the maybe not so liquid pair, I might go pound yen and pound US dollar. Okay, pound dollar is a major, but it doesn't have as much volume as these others. And pound yen. Pound yen, they call that the dragon, the widowmaker, and it can make a lot of pips. It can take a lot of pips too, but it's a very fast mover. In fact, I think I scalped in front of it when I did my live presentation at a hotel. I scalped pound yen in front of like a crowd of 300 people, and I got 22 pips in 3 minutes. It was a beast. Okay. Now another tool that I use the MyForex heat map, and I'm looking for currencies which are trending up because it shows pairs that are uptrending short term and pairs that are downtrending. The uptrending ones are going to be green. The downtrending ones are going to be red. And my forexheatmap.com, and you can see that how it changes like that, and these pairs move around. And I go to forexpaydays.com and get that, and then I'm looking for maybe euro. If the euro's uptrending, that's what I'm going to be looking at. I'm going to be trading the pairs there only in the green. I'm going to avoid the gray ones, or I'm going to take the red ones short. Okay, so that's a pretty neat thing to use. So that's one tool that I use, myforexheatmap.com. Then I'm the trend. That's the next pillar. I want to look at the 30-minute trend. That's going to be while a swing trader may look at a daily chart for a directional bias and then maybe take signals off a 4-hour chart, I'm going to look at a 30-minute chart as my directional bias, and I'm going to take trades off a 5-minute or even a 1-minute chart. Okay, and I try to scalp only in the direction of the market tide. That gives me the edge, but I'll take some counter trend moves too. Okay, now scalping is a 30-minute trend usually results in losing trades if you hang on them too long. If you're trading counter trend, your scalping targets have to go down and become smaller. So if you're going for normally 10 or 15, if you're going counter trend, maybe you're just going for 10 or 5. You get to your little nickels and dimes, and you can hit those repeatedly because you get these little counter trends that happen a lot. Okay, so could trading be this simple? Find the trend, find the bull trend going up, the bear trend going down, finding the market tide. I use the 200 simple moving average, and that's a good way to find trend direction. I put that 200 simple moving average on every chart. 1 minute, 5 minute, 1 hour, 4 hour, daily. The 200 simple moving average. There's something about it that when price tags it, price bounces, and if it breaks above it, it stays above it for a long period of time. So whether it's 200 minutes or 200 days or 200 hours, that line finds a great deal of support and resistance. Lots of respect. Price usually respects that 200 simple moving average. Okay. Now the next pillar, very important, is the trigger. Trigger. On a gun, there's a trigger. You pull the little latch, and then a bullet comes out. Well, this is, in this case, the trigger is an indicator or some type of indication that we should get into a trade. That's what trigger means, something that gets us into a trade. Whether it's price breaking a support and resistance trend line, which is my favorite, or price bouncing from support or resistance, like bouncing from a ceiling or a floor in price, that could be a trigger to get into a trade. Price crossing a moving average, like crossing above the 200 simple moving average, is a trigger to get into a trade. A candlestick reversal pattern, such as a morning star or a hammer, that could be a reversal, could be a trigger to enter a trade. And the last trigger that's not my favorite, because these are lagging indicators, are stochastics and MACD crossovers. I do have a 1 minute MACD crossover strategy where when you go to a 1 minute chart, when MACD signal line crosses the MACD line, it generates a signal, but it's like you get like 5 pips, and then it turns around and goes the other direction. So it's one of those things, like 2 wires that cross, and there's, with blue and red you're dead, and yellow and you're a mellow fellow, or something like that. You see the Die Hard movies where the guy has 2 wires and you have to cut the wires. Well, MACD and signal lines like 2 wires. When they cross, you usually get a movement in price. You might want to try that in a demo account. Okay, so it is price breaking a resistance line, and yeah, here is a resistance line at this dotted yellow line, and this, I believe, is a New Zealand dollar, and it broke. And I think I posted that in Twitter too. If you follow me on Twitter, at Greg McLeod Trader, TRADR, I posted this trade. Price broke it, came back down, and then came back up, and then broke out. Tested that line again. See, price returned back to the scene of the crime, and then came back and hit my limit, and was able to get some tips on that particular trade. So again, a price breaking, that's a trigger. When it broke the trigger, it did suck me back in, but my stop was down below here, and it never came back down to my stop. So that trigger, that price hidden there, I saw the price hit it, and I took it. There was no if then. Let me see. Greg, GREGMCLEOD, TRADR. Okay, right there. It's so funny. You put Sylvia on there. That's my ex-wife's name, Sylvia. I don't know where that came from. It's so very interesting. Anyway. Next one. Yeah, here is price bouncing from support or resistance. Okay, so this is the opposite of a breakout. Price came down. I had a low. I had a morning star formation. This is a morning star candlestick formation. Bearish candle, small body doji, kind of like a cross. Then a bullish candle. You'll see that happen a lot. And then price rallied up, came back down. It was rallied up on a Tuesday. It rallied up, came back down to support, and then gave me a bounce. That I waited for the bounce and got long there, and then I just grabbed multiple. This trade, this hit it. Each of these triangles is a trade, and I hit this several times on the way up, and then we came back and broke the old high. On a double bottom, the target is usually if you see, it looks like a W. The letter W, okay? The target is that middle part of that W is the old target. So I was clocking them, hitting them, and then when we hit that top, I got out, and then we broke out, came back and touched the top of that resistance line, got long again, and it rallied back up again, okay? So you can play that double bottom like that. You can draw a trend line across this. You can place a trend line break. You can play the break above the old high, and then you can look for this old level of resistance up here to be to be the target. Okay. And let's yeah. So 2 ways: to bounce, the break, and also we broke the moving average as well. Another entry there. So we got 1, 2, 3 types of entries right here. Those are all triggers. But you have to train yourself to take it, because you can't because it's easy to see it in hindsight. Oh yeah, Greg, I would have taken that. No, you wouldn't. You know why? Bearish candle, white candle, bearish candle, white candle, bearish candle, white candle, bearish candle, white. I'm scared. You want to go long? No, I don't want to go long. Bearish candle, white candle. Oh, I don't. Your brain goes, oh, I don't want it. What if it goes down again? And then you freeze. Well, and then you freeze, and then it moves again, and it keeps going, going, going. And by the time you condition yourself to say, okay, I'm going to take this trade, it has already moved more pips than you lost out on all this opportunity because you froze. But you have to, the trigger is, if the price comes down and bounces, I will get in. There's no debate. There's no thinking. No, let me ask my friend. Let me consult my Ouija board, my horoscope. No, you have to discipline yourself that when you see the bounce, that you take it. And that only comes from practice. Okay. And here's price crossing a moving average. This was a Euro CAD. This is the Bank of Canada rate decision, and we broke the moving average and came straight down. And there's also a trend line here. And actually, I didn't take this. I drew the trend line, and I think I went and got some coffee. That's what I did, and it broke the trend line. If you connect the swing lows of the rising trend line, it broke. And so I was very ticked that I didn't take that trade, because it was setting up uptrend, trend line break, moving average break, and massive drop when the Bank of Canada kept rates unchanged at 0.75%. That's a Bank of Canada move. Now here is a trend line bounce here. You really really that circle should be over here, because you don't have a trend line until you have 2 points. So your first point's down below. The second point is the circle, and the third point here is not circled. That should be the point where you should get long. You couldn't get long here because you didn't have a trend line. Okay. You could draw a downward trend line across the top, and then we got a whiteboard here, right? Oh, I can draw on that? Oh, no way. I love this program. Okay, can you see that? Can you see that trend line? I can see it, but I don't know if you can. I don't know if I can undo it. I can do a straight line. Okay, and so actually, that one would be your bounce, and bounce the trend line, or so you draw this downward trend line. The moment that trend line breaks, you're long, and you're in it, because this is like what we call a falling wedge. And yeah, you got this falling wedge or bull flag. You have a flag, basically a flag pattern, and then we broke the flag here, and then we traveled up. So that's our trigger, and we could get in there. Okay. Can you guys see these lines, or is it? I can see them. Can you type yes if you can see them? Okay. This is my first time. I clicked something I clicked a pencil, and this came up like, whoa, whiteboard. I get it. Cool. Oh, no, I can't. No, it's going crazy here. Okay. So I'm back. If I go back to the other slide, and so this is the trend line. That's the trend line, and that was the break. That one candle close. That's your signal again. You get one candle. You had 2 candles, and then boom. Okay. All right. Thanks, Timmy. And let's go back. Okay. Now this is our stochastics crossover entry, and this one I'm using a tick chart, where once you get your 30-minute trend direction, I create 2 charts side by side. I have my 30-minute chart over here. Okay, so I got my 30-minute chart on one side, then I have my 24 tick or my 1-minute chart, 5-minute chart on the other side. And then what I'll do is I'll draw. I go, this isn't an uptrend. This 30-minute chart is an uptrend, and then I can drop down my chart here, and when this shows me a stochastics crossover, where stochastics crosses above the 20, that's a little white line down below, right here. And when that cross up, that's my trigger to get into the trade. Because what this tick chart is magnification of that little spot right there, that little right here. All this action is going on inside that candle. In that 30-minute candle, you're really not going to see any of this action. But the crossover here is my signal to get in, and then boom, I'm clocking pips. I'm clocking 4, 5, 6 pips in here. I'm 30-minute chart. I'm not going to see it, and I'm in micro world, and that's where I'm scalping. I'm scalping because usually things start off in small. When you grow an oak tree, you start with an acorn, right? Everything starts off as an acorn and then turns into a big tree. In fact, there's a million walnut trees in a walnut or something like that, right? Or an oak tree and an acorn. So I look at the smaller time frames as the essence or the beginning of these larger moves. In fact, look at that candle there, and look at that big blue candle after that. Well, that is all that came after that. So that small move, that little ABC move, created all that after that. So a lot of people discount, well, short-term charts are risky and they really don't mean anything. It's just a lot of noise. It's like, no, it's the beginning of trend. Everything's fractal in relationship. Everything starts off on the small and then expands into larger time frames. So that is that is the last of the of our triggers there. And let me go ahead and move this. My mouse just moved around. But let me know if you have any questions. Go ahead and type them in the chat box. And very interesting where my mouse cursor. Oh, it's something way over here. I have like 5 screens. Like, where did the cursor go? And yeah, that's it. Let me know if you have any questions or comments. And just remember that we're going to have you're going to stay tuned to proper money management. That's coming up as well. And there's also a drawing coming up too for $500. And I'm going to actually look at we've got a couple minutes left. I'm going to maybe share with you my chart screen. No, I'm trading with standard lots. I'm trading maybe $1 a pip, $2 a pip, even up to $100 a pip. The time frames they're using are micro, but the position size, if you look at who's scalping out there, it's not just ma and pa or some guy in his bunny slippers in his mother's basement, but it would be you actually have big banks, institutions, hedge funds, all of them trading short-term trading. Yeah, I believe that they're going to have make these videos available to you at a later date, and so you'll be able to watch them again. I'm not sure of the logistics behind it, but I'm sure that it's because it'd be very helpful to you. I'm trying to bring up a chart here. Missed the first one? Okay. Yeah, that was a good one. Yeah, that one was recorded, and just trying to see if there's anything out there. See, 340. You get into like New York traders are kind of heading home, and maybe I'll go down a 5-minute chart, maybe a tick chart. John B, is all this in the manual mentioned? I believe so. So like tomorrow we're gonna have non-farm payroll. So widely expected for we are going to have a if you watch a 1-minute chart, you're gonna see some fantastic fireworks in the market. Looking at charts right now, I'm not really seeing everything's kind of ahead of non-farm payroll. Everything's gonna be kind of paralyzed. Just trying to bring up a real chart if I can maybe share desktop sharing application. How about that? Allow access. Oh. I don't know if you can. Oh, okay. Application. On market scope. Okay, there we go. How do I determine the amount of the pip for each trade? If you look at based on the size of the position you want to take. For instance, let's say if I wanted to create a market order. Okay, I don't know if you can see that. Okay, so I can choose the amount in K. See, look, 10K, $1 per pip, or I can do 100K. Now it's $10 a pip, and the amount of margin I have to put up, I have to put up $3,400 to trade 100K. Or if I want to trade $1 a pip, then I have to put up $340 in margin. This is U.S., so it's higher margin in the U.S. Or I can trade can I trade a micro lot here? Yeah, I can trade a micro lot, 10 cents a pip, and it's $34. Okay, that's the amount of margin I have to put up. So if I want to place a trade, I can choose the leverage. It's customizable. I can choose any amount I want. I can choose. There's a drop down menu. I think you can see. I can choose 50K. That's $5 a pip, but I have to put up $1,700 in margin. Okay. So if I wanted to place a trade, I can just click OK, and my trade will be placed in the market. I'm not seeing. See if I could go to euro. That's a big spike there, big news spike. This was when they decided to keep rates unchanged. The announcement caused a big spike up, and I was scalping that up, and then we had this drop down like that. And in the trading the news, I'm gonna cover that in more detail. I just go through charts and look. I got my 5-minute here, and then I have my 30-minute, or I can make one side 30, make one side 5, and then I can link these two together with this red ball. So when I change one, I change this to, if I change it to euro yen, that becomes euro yen. And then I can look up. Oh, and we can get rid of that. Move and remove. Okay. This is euro yen. Yen's been a euro dollar. Oh, these should be linked together. Oh, there you go. They're linked together. So if I can go Aussie yen, and you can see that the Aussie yen has rallied up, and I can put in support and resistance levels. I can put a floor. We had a floor right there. There's our double bottom right there. See that? Oh, I don't think you can see it. Can you? Maybe was showing your. I'm not sure if you can see my screen. Okay. And so we had a bottom here, a bottom here. There's your trigger. You get long and strong, and boom, nice move to the upside. And it took 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55. Like about an hour and 10 minutes for this move. And if we took our ruler up there, and let's say we got, so that is 19.5 pips. So if you're trading at $1 a pip, $19.50. If you're trading 10 cents a pip, then it's $1.90, like $1.95. If you're trading a 100K lot, there's $195. Okay, at $10 a pip. And let's maybe go to a 1-minute chart. And all right, here's our. So there's our 1-minute chart. We can draw a couple of things going on here. We have a trend line across the top in case it breaks. We have maybe a little mini triangle going on there. Okay, and if we get a break, maybe we get a break. Maybe it moves fast enough. Maybe we can get short. Okay. I can probably put a. So what I'm looking for is a trigger. Okay, a trigger to get into the market. Okay. So once. So I can even set some type of automated strategy. I can right click the chart and click an entry order and say, hey, when this thing crosses here, it will get me long. Okay, so there's an entry order. So it's like a rabbit, a little rabbit trap. When it crosses the wire, boom, the box falls on the rabbit. Well, there's my buy stop. I can have a sell stop down below and say, hey, if it crosses below the bottom, I can go ahead and create a entry order to get short down below. Okay. And so if one of these gets triggered, then I can look to take profit when one side is triggered and it moves to a profit point. But right now there's not a lot of things going on there, and so we're just kind of stuck. So, any other questions? I guess we're going to go ahead and uh, take a break. Oh, whoa. Something just triggered. so we got so a price did move, and I'm looking at a bid chart instead of an ask chart. Let's see. Something just triggered. Let's see if it keeps going down. Or now, see, already with the spread, we're already down 2.7 pips. And sometimes when you're trading a 1-minute chart, the spread, we probably want to have this down a little bit farther down to cover the spread. Because it didn't look like it hit the line. Looks like it got me in before it hit the line. And so now it's going the other way. Okay. Cancel. Okay. So, okay, so we're up 0.6 pips. We're up a pip. We're up 1.2 pips. we made a pip. Okay, so there you go. Now, again, I just doing this for the sake of showing you something, how fast I can get into a trade and get out of the trade. Um, so what did I make? I may have made $1 maybe. I don't know how much I made. Let's all right. Yeah, I made 83 cents. Okay. Yeah, I made a whopping 83 cents. So that's it, ladies and gentlemen. That's you saw a scalp. It took 2 minutes to make 83 cents. But if I was trading a 100K lot, then it would have been like $8.30. Um, but usually I can scalp for a little more than that and do it several times a day. So you got to see a little Pip and Run there uh, during the Asia session. So that's gonna be it for me. Okay, Jeff has a question. How far past take mm, a trend line or MA does price have to move before you can confirm entry? I.e. a false trigger. How would you set your stop loss? Yeah, I'd probably give it Jeff, give me a little buffer zone of maybe like 4 or 5, even maybe 10 pips as a buffer zone to as far as maybe so that way to avoid maybe the whipsaw or the false the the false move. So and everything's kind of flickering out here. There we go. And actually we did move past, and we can see that it's still moving. You can see how we hit a price floor and it kept going. Okay, with that, I'm going to go ahead and we're going to go ahead and finish up. And I think
Thank you, Greg.
Dan, are we going ahead and finish this off? Okay. All right. Thank you so much, ladies and gentlemen. You guys have a great day, and stick around
Thanks a
for
lot, Greg. And it's great to see everybody
more
so engaged here just
boot
after the
camp.
first webinar of the day. There will actually be 6 more, so actually a little bit longer than yesterday's first day of the boot camp. So hopefully everybody's enjoying it and getting the maximum value out of it. Just a quick couple of announcements. One, congrats again to Tarek Chediak yesterday, who won our first raffle of the 2 raffles we're doing throughout this boot camp. So nice little $500